Good morning, everyone. Good morning, everyone. Today is September 8th, Monday. It is so good to see you all this beautiful Monday morning here in Austin, Texas. Lots going on over the weekend, and we are going to do our famous Monday morning touch point where we are going to update the single best leading market indicator available, and that's going to be the new listing to pending ratio. And we're going to take a look at the entire market, what's going on with active, what's going on with pricing, and you can see behind me, take a look at behind me right there. Hopefully you can see it. The bond market. You all, things are looking really good in the bond market, not for good reasons, but things are looking really good and really positive in the bond market. So we're going to talk about that because that is very much positive for rates. We officially have the best rate environment that we've seen going back an entire year, and that is causing buyers to look at the market. And if you saw my email that was sent out yesterday about cap rates, because the bond market is going down, every single yield is going down from the 6-month to the 10-year to the 2-year. But when you look at the 6-month yield, which is a benchmark that we use for investors use that benchmark. Do they want to put their money towards tenants, toilets, or do they want to put their money towards something like a 6-month T-bill, short term, where they can just park their money there, get a higher yield, and reevaluate their decision 6 months down the road? That yield is down, and because pricing is down and we're noticing stability within rents, then that means that cap rates are actually up within the Austin area. We now have 23 zip codes where the cap rate for that zip code, when we take a look at the median lease price and the median price, is actually higher than the 6-month T-bill. That is causing an influx of investors looking within the Austin area, and that's really exciting. 23 out of 75 zip codes now have a cap rate that is higher than the 6-month T-bill. We know, based on history and based on our own experience, that once that difference is on the positive, even a tiny little positive, but the number that we're looking at is a positive one. Right now we're negative 0.16 or so. I'll have to take a look at the morning reading, but we are slightly negative, which is a dramatic improvement for what we've seen over the past 2 years. That is now causing landlords, potential landlords, investors to look at the Austin market. And we do a fairly good job tracking Google Trends, what people are searching for. And we are noticing a heightened desire and interest within Austin real estate, which is really exciting. We're going to go ahead and just start by updating that new listing to pending ratio. Like I said, that is the single best leading market indicator available for the entire area. And for some of the new team price agents, welcome, Helena. We have you right here. Helena just joined Team Price along with her husband, Ryan. It is so good to have you here. Welcome to the team. This is your first, I believe, Monday morning touch point. You probably watched a few online, but this is your first one, so let us all give them a welcome to Team Price. Thank you for joining. Super appreciate it. It is really, really good to have you here. Let me let a few more people in. We've got quite a few people that are joining here online. You all, so let me do a really brief overview on what this new listing to pending ratio is, and so that we can all understand why is this so important. You know, sometimes the simplest things in life are the best ones. And this is a very simple ratio. All it does is simply tracks everything that is new on the market. We then add everything that is back on the market, and then we simply divide that by everything that went active, under contract, and pending. We're just going to get a very simple ratio. When the ratio is 1, that means that we had the same number of properties come into the market that left the market, were absorbed by the market through buyer activity. That's a ratio of 1. That means that we have what's called a perfect market equilibrium. Inventory is neither going up nor going down, excluding expireds, excluding withdrawns. We just leave that. We park that off to the side, because real estate does have this natural market cycle where from June, July, all the way through December, inventory goes down simply because of listing attrition and give ups where people take their homes off the market. But we simply look at this ratio on the demand side of it. Is demand exceeding new listings coming into the market, or is demand lagging new listings coming in the market? When you have a ratio of 0.5, that means that out of every 2 listings entering the market, half of them are being absorbed by the market. And that's not a good ratio. That's really bad. That means that the market is having a really tough time absorbing that new inventory. And of course, when you've got a new listing to pending ratio of the 1.2, that means that out of 100 properties entering the market, 120 are being absorbed by the market, which means inventory is going to plummet because now you're drawing from that existing inventory pool. You can see that we've been updating this information for a very long time on the monthly. I've been updating this information since January of 2020. So we've got a lot of really good historical data so we can get a really good pulse on the market. The question that I oftentimes get is, what data do you rely on? Like, what's like the number one go-to data that every day you take a look at what's going on with the market? Number one, it's this one right here, the new listing to pending ratio. Number 2 is going to be the activity index. That's where we take the pending and we divide it by the active plus the pending. Very simple, activity index. Those are 2 leading market indicators. I'm a firm believer that we have to rely on leading market indicators. Lagging market indicators is what the world relies on. That's going to be the sold price. That's going to be months of inventory, number of sold properties. That's going to be the lagging market indicator. And oftentimes, that's going to be at a minimum 30 days old, usually anywhere from 60 to 90 days, especially when you take a look at months of inventory. Well, let's go ahead and start updating this information. First thing we're going to do is we're going to go backwards in time a little bit to see if any agent or builders, usually builders, if they updated the information late, because they can always go back and update some of the pending information 2, 3, 4 weeks late. And this number is going to go from 360 to 370. So there we have it. There we've got builders and agents that are 5+ days late on updating the information. And let's see if we have to update the active under contract. That's going to be 452. So we do have to update this to 452. Now let's go back a few more weeks, 18 through the 25th. The 502 doesn't change. Let's see if pending changes. That's going to be 446. Let's keep on going from the 11th to the 18th. That's going to be 470. Great. So now everything is updated. We can see that 2 weeks ago, we had a new listing to pending ratio of 0.75, meaning out of 100 properties that came into the market, new listings and back on the market, 75 were absorbed by the market. That's going to give you a balanced market. That's actually a fairly decent ratio. Now, we did just get done with going through a 0.82, 0.83, 0.82, which is a fairly decent ratio. Now, we can see that over the past few months, we were borderline in danger territory. 0.63 is not good. It's pretty bad. Thankfully, we bounced back up a little bit, but then we started getting back to the 0.6s. Anything under 0.7 is going to give you that tangible increase in inventory. Anything under 0.6 is going to give you a substantial increase in inventory. Anything under 0.5, it's a crash market. Market's crashing. Now, as I update this week, I do want to remind you that, as we know, agents are really bad when it comes to updating pendings. So every time we meet Monday morning, we always get a lower reading than the historical reading going back, because we can all see that we're going to be adding pendings over the next 2, 3, 4 weeks. So when we are updating this information Monday morning, if the ratio is under 0.4, that's really bad. Between 0.4 and the 0.55, it's a little bit softer than we're expecting. If we're updating this on Monday morning and we're getting that 0.6 plus ratio, that's really good. That's pretty decent. So keep that in mind as we start updating this. So what we're going to do is we're going to go from the 1st to the 8th. We're going to take a look at new listings, and we are at, oh, interesting. I was not expecting this. Interesting. Here's another thing. It is 10:11 a.m. right now. Agents can continue to add listings until 11:59 p.m. So that's why when we update this information tomorrow morning, you're going to receive an email first thing tomorrow morning with the latest and greatest new listing to pending ratio and new listings, price increase, price drop back on the market. It locks. It never changes ever again. Active, under contract, and pending, we will keep on adding to these numbers as agents update the MLS. But anything before that gets locked in. So right now, even though we have another, 13 hours and 48 minutes left in the day, we are already at 912. 912 new listings. Not necessarily what I was expecting. We should actually start noticing a drawback in listings and new listings. So here we already have a little bit of a bump up compared to the previous week. Now, I get it, previous week, Labor Day. So we do notice a tiny little bit of increase from Labor Day to the following week. People don't want to put their homes on the market in Labor Day. But still, when you take a look at this 912, something that we need to be aware of. Let's take a look at how many price increases. We are looking at 162. 162, that's going to be the lowest reading so far. It will beat out the 164 for last week. Keep in mind, we have 13 hours and now 47 minutes left in the day, so we are going to have more listings with a slight price increase. Let's take a look at price decrease. We're at 1652. That's going to give us a 91%, matching the previous week. Let's take a look at back on the market. That's going to be 193 back on the market, 21%. Really steady. The average is 22% when we go all the way back to May. We're at 21%. That's a steady number. Let's go to active under contract. We're at 302. And now, you know what it means right now? I need 5 guesses. I need 5 people to write down over chat your guess on how many pendings we've had over the past 7 days. We've got Austin starting us off at 275.9. We've got 1 down, 4 to go. We've got 259. Seth coming in at 259. Harold is slightly bearish at 235. Precious at a fairly bullish 300. We've got 3 down, 4 down. Bertina at a bearish 202. And let's just get one more person going, even though I think we have 5. Let's get one more person guessing how many pendings. Okay, we've got Renee at 250, Charmine at 240. Let me go ahead and click on this figure. The number comes in at 204. 204. So we're starting off the week at very close, 204. We're starting the week at a 0.46. Not terrible, not terrible. That means that when we reevaluate this information, this data a week from now, we're going to be slightly softer than that 0.75. I expect that we end the week after we update everything, something closer to that 0.69, something closer to that, 0.7-ish or so. So it's a little bit slower. Well, why is that? There's that number right there, 912 new listings. So let's do a comparison. Year over year, exactly the same week, year over year. And we can see that we now have 2 preceding weeks where the pendings are just backtracking a little bit. Not so much from August 18th to August 25th. We're down by only 3. We're going to make that up here in the next few weeks because agents are really late when it comes to updating pendings. That's going to be positive. We are down 116 pendings 2 weeks ago, even though we're up 72 active new listings entering the market. And we're up 23 on the back on the market. So a year ago, 2 weeks, if we go back 2 weeks and then we go back a year, we had a new listing to pending ratio of 0.94, whereas this year, 0.75. When we take a look at 3 weeks ago, we had a new listing to pending ratio of 0.87, and then we've got 0.82. So we are noticing a little bit of resistance. There's a lot of positive momentum within the market, but now we're noticing just a tad bit of resistance, which is interesting because we've got the single best rate environment that we've had in a year. That's why we track this information on a weekly basis. This is surprising for me just to see us being slightly negative on that pending 2 weeks ago by 12.4%, which means I do not foresee us going positive. So here we have a situation where we've been positive on the pending year over year for 8 weeks in a row. And now we're going to be positive here. So I'm going to be bold and say that it's 9 weeks in a row. We've been positive on pendings, but now we're noticing just a little bit of a pullback on properties going under contract. Well, how is that going to influence the total number of pending properties? We're going to go over that information here shortly. But as of now, we are down 402 on pending. We're going to make up a lot of good ground on this 402. I'm not concerned about this number right now, but it does show us that we are going to be negative 2 weeks in a row. This is going to be positive. We're then going to go negative 2 weeks in a row. Let us start updating the monthly. The monthly is going to be exactly the same as the weekly because this is one of those unique weeks where the week and the month match exactly. So we're going to go 912. We're going to go, let me just update all this information. 162. 1642, there's that 91%. Let's go back on the market. That's going to be 193. Let's go active under contract. That's 302. Pending, let's update this really quick. 204. Now let's take a look at withdrawn and then expired. And then I'm going to update the closed using a different screen. And we're going to go expired. That's going to be 139. Now, let me go to a completely different screen. I have to use a different screen to get the sold information, but it's just going to take me just a few seconds. So far this month, we've had 395 sold. And let's update the sold for August to see if we can. Okay, this is going to be 2644. Let's go to July to see if we have any new sold data. And that's going to be exactly the same. So there's the monthly. So far this month, we're only 8 days into the month. We are at a 0.46 right now. Not concerned about this. Too early to tell how the entire month is going to play out. Positive movement within the bond market. Let's see how many buyers come back into the market, and let's see how much this is going to go up. Last year, we were at a 0.80. We always improve towards the end of the year because we have less new listings entering the market. Statistically, December tends to hit those ones. 1.03, 2023, 1.08, 2022, 1.03. And then take a look at 2021, 1.29, which is just a market that's on fire. And the highest reading ever recorded going back to January of 2020, 1.34. That was December of 2020. It's the highest reading ever recorded. That you just cannot get a number higher than that. It's just really amazing. So there we have it. We're starting off at a 0.46. That number is going to go up. The big thing is going to be, are we going to beat the 0.80? It looks like we are not. And the reason I say that is because we now are backtracking on the week over week numbers. So as of now, it does look like September is going to be slightly softer than September of 2024. But that's why we meet every Monday morning and we update this information. One thing to keep in mind is that so far this year, we have had a staggering 16,231 properties withdraw or expire. Just let that sink in. We've had, and this is in the 6-county area, we've had more properties expire and withdraw than the total number of active properties within the 6-county area. a certain number of these are going to hit the market come what? February, March. I am expecting an increase in activity, new listings entering the market February, March. Same thing that happened this year. We now have a very short selling cycle in Austin. Everyone is trying to preempt the listings entering the market. So if you've got those sellers saying, I'm just going to wait until the spring, I've got two recommendations. One, can we list this home in November? That's going to be my recommendation. Middle of October, November. We always notice this December bump. And as new listings start going down, as active listings start decreasing, I would much rather enter the market with lower inventory and yet with buyers out there with favorable mortgage rate environment than waiting until March, April. My concern is that if you wait until April, you're going to miss the mark. Now you're going to be one of 20,000 active listings on the market. I do believe that this next year, 2026, is the year we're going to cross 20,000 active listings. We got really close this year, but when you look at all the withdrawns and expireds, I just don't see a place where we don't hit 20,000 active listings in 2026. So preempt that rush of new listings that we're going to notice by listing it in November, ideally middle of October into November. Get that December bump and just hold firm. Any questions about the new listing to pending ratio, you all? Any questions, comments, concerns, criticisms, complaints? Any questions? And also check your email tomorrow morning. You're going to get the latest and greatest where everything locks in from the new listings to the price increase, price drop. Be sure to check that. Also, want to remind you that you can always get the updated new listing to pending ratio by going to Insight and Statistics. Scroll down a little bit, click on that new listing to pending ratio. And this is one of those ratios. I update this information on a daily basis, and you can always get the latest and greatest right here. Now, we've got a few more topics to cover. We're going to take a look at the economic calendar and what can we expect this week and how will it affect rates. And then we're going to do a market overview, take a look at what's happening within with inventory. Let's start with the economic calendar, and then we're going to discuss rates. We're going to start by looking at the Consumer Board Employment Trends Index that did come in a little bit softer than expected. Employment's been one of those tough topics over the past few weeks, and we are going to have some revisions, some payroll revisions that are going to, hit the economic calendar here in the next 2 weeks. And I'm telling you right now, it's going to be brutal. I'm just going to lay it out there. The employment data is going to be brutal, and the market is forecasting this. That's why we're noticing such a big drop in the 10-year yield, and all yields are going down. Things are not looking good right now when you look at employment figures. We had really bad numbers this past week. All the jobs created were part-time jobs. No full-time jobs were created. And across the board, we're looking at really bad employment numbers. That's causing the drop in yields. Now, I'm not going to get into the whole blame game. There's a healthy discussion on what's happening. Some people are blaming the Fed. Some people are blaming the tariffs. Some people are blaming the administration. Bottom line is, that's the data. Brutal, bad employment numbers. All we can do is take a look at the data and say, well, how does it affect us? How does it affect rates? How can we position our clients in a competitive way so that they can make a really good decision? So what do we have going on this week? We've got a lot of inflation numbers going on this week. We've got CPI, that's going to be Consumer Price Index. That's going to be inflation. That's going to come out on Wednesday. Super important. Then we roll into Thursday and we've got CPI, we kind of go here. We've got PPI. So I inverse this. We've got PPI on Wednesday. We've got PPI. That's going to be Producer Price Index. That's going to be the input side of inflation. How much are producers paying for that raw material? And then we go into Thursday and we've got CPI. That's going to be the consumer side of things. How much are the consumers paying after the producer manufactured that, and now how much do we pay? And you can see right here that they are expecting year over year CPI to go up from 2.7, and that's going to be the consensus is 2.9. So the market, the forecasters are expecting higher inflation numbers. Month over month, they're expecting the same. And then we go into Friday. A lot of data coming out Friday. That's going to be the famous Michigan one-year inflation expectation. We've got the 5-year inflation expectation, consumer sentiment. Those are going to be preliminary figures. But all of this data is going to lead up to next week, because what is going on next week? Next week, we have Fed rate decision. The FOMC, the Federal Open Market Committee, they are going to decide on the 17th what in the world are they going to do with rates. 90% chance that they're going to lower rates. Even though we've got a heightened inflation environment, that's true, the data points to that. We have a terrible job environment, really terrible. I mean, no one can just spin the data from last week. It's pretty terrible. And they have a dual mandate: price stability and maximum employment. So are they going to focus on price stability and say, well, we still have only 4.3% unemployment, so we're going to view that as maximum employment? We're now concerned with a heightened inflationary environment. So are they going to hold steady? If they decide to hold steady, rates are going to go up. Bottom line, because the market is forecasting that they're going to reduce the overnight lending rate. Or are they going to say, I don't care as much about inflation right now. We're now going to focus on jobs. So we're going to lower rates. Now it's, what are they going to lower rates? Is it going to be 25 basis points? Is it going to be 50 basis points? The market is forecasting a 50 basis point decrease from 4.5 to 4. So everything that's happening this week is forecasting that decision on the 17th. Anything that goes against that decision will affect rates. But in the meantime, everything is forecasting that. So what would I do if I were a buyer right now? Same thing I've been saying for 2 years. Work with a lender that allows the buyer to lock and float. What does lock and float mean? You lock your rate right now. If the rates go down, you can capture that lower rate environment. Some lenders will allow a 1/8 of a point float down at no cost. Other lenders, a 1/4 float down. Well, what does that mean? 1/8 versus 1/4. Let's say that right now your client locks in a 6.25. Some lenders will require that rates be a 6% to capture that 1/4. That's going to be that 1/4 float down. Other lenders will say, as long as rates go down by 6.125 down to 6.125, we will lock that in at 1/8. That's where the buyer needs to have a discussion with the lender just to see what is the best strategy for that specific buyer. But I will say right now, if I were a buyer right now, I would not wait until Wednesday, Thursday, until PPI, CPI figures. Because what happens if, and these are big what ifs, what happens if inflation comes in way softer than expected? Well, if it comes in softer than expected, I would actually say that that's even going to give more ammunition for the Fed to lower rates. So let's inverse that. What happens if inflation comes in like crazy hot? What if the core PPI month over month does not come in at a 0.3, comes in at a 0.5? What if CPI does not come in at 2.9, but comes in at 3.2? Well, now the Fed is like this impossible position. They're like, inflation is getting hot and we've got a terrible jobs market. And they've got the dual mandate that is now competing with each other. What are they going to do in that situation? We will not know until the 17th. So this is a very important week, and yet we don't know what's going to happen until the 17th. Now, what happened last time the Fed reduced rates? did it cause a reduction in mortgage rates? No, it didn't. And the reason why is because the market had already preempted that decision and the reduction wasn't as high as the market was expecting. So rates actually went up. All we can do is look at what's available right now, what's happening right now, and how can we help our clients make the best decision right now without forecasting what in the world the Fed is going to do and what in the world is going to happen with mortgage-backed securities. But I will say that we've had a very positive past few months when you look at mortgage-backed securities, when you look at mortgage rates. Once again, best environment we've had going all the way back 1 year, which is causing Austin to be the most affordable September that we've seen going all the way back to 2020. So buyers that have been on the sideline right now are looking at properties and they're saying, I'm comfortable. I'm comfortable with this price. I'm comfortable with this rate. Let's go ahead and move forward. Let's take a look at what rates are now. Let me go to resources.teamprice.com. Front page of resources.teamprice.com, you're going to see a tab that is called mortgage rates. And here's Robert's information just in case you need it. And here's the good news. Take a look at FHA, VA, USDA. We are now well under 6%. We're at 5.75 on VA, FHA, USDA, which is fantastic. On conventional, we're at 6.375 with some clients getting as low as 6% or using that seller concession to buy down that rate to the 5.875. And these are numbers that we have not seen for quite a while. So this is really good. It's good positive movement for the market, something that we're really excited about. Let's take a look at the daily real estate briefing. This is something that we update on a daily basis. I want to remind you that you can find this daily real estate briefing when you go to teamprice.com, scroll down. Here's your daily market snapshot. Every morning we consolidate out of the 2,500 plus pages that we update on a daily basis, Monday through Friday. I extract the top pages, something that every day, a part of your checklist every morning should be you wake up, you take a look at the daily briefing, then you go to the bathroom, then you brush your teeth, then you get some coffee. But this ought to be your what is happening today with Austin real estate. What's happening right now? How many active listings? What about price drop? What's the activity index? The more you review this information, the more these numbers are going to make sense. And you never know. You know, one of the blessings and curses of real estate is what? Is everywhere you go, someone's going to ask you the question, how's the market? That's the blessing of real estate. And what's one of the pains of real estate? Everywhere you go, someone's going to be asking you, how's the market? Like no matter what, you could be at a wedding, you could be at a funeral, all right? They're going to sneak in like, hey, by the way, how's the market? And you're like, are you kidding me? It's like, we're at a funeral. Now they're going to ask you, how's the market? So we have to have the information. You've got to have your, I hate scripts, but you've got to have your answer. Hey, this is how it is. Hey, we've got, right around 17,105 active listings. And when you throw some figures, some really accurate figures, people get impressed. So this Austin Daily Briefing is going to be your go-to, the top reports out of the 2,500 plus. I extracted the top 34 reports that you ought to be looking at on a daily basis. We're at 17,105 active listings currently on the market. As you know, our high was Monday, June 30th at 18,146. That was when the market peaked this year. Last year, the market peaked July 15th. This year, the market peaked June 30th. I do expect to cross 20,000 active listings next year. I do expect that because of all the withdrawns and expireds. Out of all the 17,105 active listings, 57.9% of those have had a price drop. We got as high as 60%. 57.9 is the number this morning. Now, here's another number. I've got another screen that I want to share with you. What's happening with short sales, you all? Are y'all noticing more short sales out there? Yeah, guess how many short sales are currently in the market right now? Just take a guess. What do you think? How many short sales currently on the market? Any guesses out there? Let me just go ahead and give you the figure. We're up to 70 right now. We're up to 70 short sales currently on the market right now. So this number is going up, and it's going up by quite a bit. As a matter of fact, one of the things, the reason why I do the weekly recap, it's not because I expect anyone to read this stuff. No one's going to sit down and read 800 pages worth of data. The reason why I create the weekly recap that is sent out every Thursday, it's so that we can get a snapshot of that week, and we can reference that snapshot a year later, 2 years later, 3 years later. So let's go ahead and do that right now. Let's go take a look at September 5th, 2024, and let's take a look at the 691-page document with all of the stats. And we're going to it's going to be mortgage rates. Then we're going to go to the active residential listing. The second page of active residential listing is where we're going to have the number of short sales. And take a look at this. A year ago, roughly, today is September 8th. This is from September 5th. We had 28. Today, we have 70. That's a pretty big increase if you ask me. That's a fairly decent increase. So we are noticing this number going up quite a bit. And that's something that we need to be on the lookout for, because guess what happens when you start noticing short sales enter the market? And by the way, if you click right here on short sales, it's going to give you the breakdown of where are the short sales happening. And you've got the 76537 is going to be the number one zip code for short sales with a total of 6 active short sales. And take a look at the price drops on those short sales. We've got properties that are from $200,000 to $300,000 that already experience a 25% plus price drop in it's a short sale. Take a look at Hutto. We've got 5 short sales in Hutto. Look at that average price, only $345,000. But take a look at that price drop. The average price drop, $66,000. Now, the reason why this is important is because these are active homes. Short sales do take a long time to close, so we're not noticing a huge number of sold short sales because some of them are in escrow right now. 70 active and only 28 in escrow. So that's going to give us the activity index on short sale of 28.57%. But take a look at that average price. The average active price is $374. The average pending price is $310. If I go and I take a look at the average sold, it's going to be closer to that $295-ish to $300. And that puts a lot of pressure within existing inventory in those zip codes, in those communities. So this is a number that we do track faithfully on a daily basis, and we are noticing a pretty dramatic increase. Now, really quick before we move on, let's take a look at the number of sold short sales so far this year. I'm going to scroll down. I'm going to click on special listing short sale. In the last page, or right here when you scroll down, we're going to see the number of sold. Let's keep on going. Right here, number of sold. So far this year in the entire MLS, this was updated this morning, we've had 24 sold short sales. And we've got 70 active. The reason I bring this up is the reason why we're not noticing a lot of pressure on pricing is because a lot of those are not translating into actual closed deals. Once they start translating into closed deals, it does give a lot of pressure on pricing within those areas. So I do expect, certain zip codes or municipalities like Hutto, where we are noticing an increased number of short sales with a lot of price drops, because a lot of those short sales are going to be previous FHA loans. When you track, what is selling through a short sale? That's going to be previous FHA loans. That's what's happening. That's going to put a lot of pressure within those communities, a ton of pressure within those zip codes. Something to keep in mind. Let's keep on going. Are the short sales in from 2020? Are the short sales in from 2020-21? Can you clarify your question, Harold? Oh, for some reason I can't hear you. I don't know why I can't hear you. I even adjusted all the sounds, but for some reason I cannot hear you. So you're going to have to type it. So are you talking about the short sales where they sold properties that originally closed from 2020 to 2021? A significant portion of those are properties that closed. Bingo. That's exactly what's happening. A vast majority of short sales or property. I would even go a little bit further than that. What's happening is those are properties that primarily close really at that peak of the market into 2022-ish or so. We all know that the market peaked May of 2022, and that's going to be a vast majority of those short sales. Another question that we have is, well, how the heck do we search for short sales? Very good question. When you go to Matrix and you go to residential, you have to search for special listing criteria. You just scroll down, and under general information, you've got special listing criteria, and you've got a few options. Choose all three options: short sale potential, short sale approved. And that's what you're going to do. Make sure that you are selecting active within the Unlock MLS. You see, according to this is actually up to 87. That's because they've actually added 2 additional categories. So I'm going to update that. So here you've got 87 properties. And take a look at the year built. We've got 2025, 25, 23, 23, 23, 23, 23, 23, 23. Look how many of these properties are 23, 22, 21, 20. A lot of them. We've got over 50% of properties are properties with an year built that are newer than 2020. So that gives us that really good indication of how many people are facing foreclosure that just bought their homes not too long ago. So that is a number that we are tracking consistently and something to be on the lookout for. Active listings, we are up 17.2% year over year on the number of active listings. We are noticing this little bit of a bump right there on the number of active listings. We had a resurgence of active listings here over the past 5 days, and there's that little bump. Last year, we had to wait a few more weeks to start getting a little bit of a bump. This year, we're noticing a higher bump compared to last year. Cumulative new listings, when we add everything, 38,717. Now, we had such a positive August. August was plus the entire month of August. Take a look. This is where I want you to focus right here. Look at this. All this was August, and all of that was plus, meaning that year over year, when you took a look at every single pending, day to day, Monday through Friday, we were positive compared to the same exact day last year. And I am not so happy to inform you that we now have a negative figure. We're now negative year over year on pendings, which is crazy because we've got a better rate environment. We've got a better pricing environment. And yeah, all of a sudden from Friday to today, we actually go backwards and now we're negative 1.5% on pendings where we've been positive the entire month of August. So that's a little bit frustrating. On the cumulative pending side of things, 31,585 total pendings from January through September. And that's going to give us an activity index this year of 18.9%. That's going to be the pending divided by the active plus pending. Also a leading market indicator. 25% activity index is going to give you that neutral market between 4.5 to 5 months of inventory. Under 25% is going to start giving the buyer way more leverage. Over 35% is very positive, gives the seller way more leverage. On new construction, we're at 26.21. And on resale, that number went down to 16.15%, which is really, really soft on the resale side of things. And we can see that we were really nice in level on the activity index from the beginning of July all the way to the end of August. And all of a sudden, that activity index starts going down a little bit. So that's something really interesting. We're going to keep on tracking this, but this is a little bit surprising to see that activity index going down. Top cities, we're looking at Manchac, really healthy at 32.1. We've got Kyle, Lockhart, Buda. Those are all really good activity index. On the bottom end of the scale, we've got 3 cities that are competing for last place: Spicewood, Dale, and Smithville. A 6-7% activity index is just downright pitiful. I mean, it's just brutal. That means nothing is moving within that area. There's that new listing to pending ratio for the month so far, 0.43. Do not be concerned with this number. We all know that it's going to go up. And here we have 0.43. Last year for the month of September, it was 0.80. I do think that we're going to be slightly lower than that 0.80. Starting off the first week of the month at a 0.43 means that we're going to end somewhere close to the 0.7 to 0.75. So that is going to be better than 2022, better than 2023. But as of now, it looks like we're going to backtrack a little bit compared to September of 2024. This is where we take everything that came on the market and everything that was absorbed by the market, and we simply look at the difference, the year-to-date cumulative difference. So we've had so far 7,132 more new listings entering the market in relation to properties that were absorbed by the market. That's going to give us a ratio of 0.70 for the entire year. And there you can see 0.70. The 25-year average is 0.82. What about months of inventory? We are slightly up on inventory because, of course, we now have more new listings entering the market, that little bit of a bump on new listings. And we also have a slight decrease in the number of sold properties. That's going to give us months of inventory of 6.07 compared to 5.21 last year. What are the top cities with inventory? Well, the top cities with inventory are the bottom cities with the activity index. If something does not go under contract, it doesn't sell, that's going to keep the lagging indicator up, and that's going to be months of inventory. We've got Dale, Smithville, Spicewood with brutal inventory figures. We cap it at 11. If you want the exact months of inventory, you're going to have to go on teamprice.com, go to Insight and Statistics, click on months of inventory, and here, if you scroll down, you're going to be able to see the exact months of inventory. So, for example, on the previous chart, we capped Dale at 11 months just so that it can look good on the graph. But the real inventory in Dale is a mind-blowing 18.27. And then you've got, what else? We've got Spicewood at 15.55 months of inventory. So pretty high, 18.27. And then we've got, look at that, 15. And we've got Smithville at 14.68 months of inventory. So what's happened year to date and what's happened year over year? Year over year, when you look at September 2024 compared to September 2025, I just want to focus on Austin. We are positive 2.1%. We were negative last week. Now we are positive on months of inventory. Number one city with the highest year over year increase in inventory is going to be Smithville at a plus 172%. And then you've got the bottom end of it, you've got Manchac, a drop by over 50% in inventory. And then year to date, Austin, we are up 24.4% year to date. Cedar Park takes the number one year to date increase in inventory at 116.8%. And then, of course, you've got Manchac down 55.9%. We are forecasting that 2,319 properties will sell this month. Last month, that number was 2,643, slightly lower than August of 2024. And you can see that we are down 4.6% year over year on the cumulative number of sold properties when you look at everything that's sold from January all the way through September. Let's start taking a look at some pricing right here, and you're going to notice something really interesting so far this month. Even though more expensive homes tend to sell in the first part of the month, we are already negative $33,000 month over month and $3,365 year over year on the average sold price. On the median sold price, we're at $415,000. When you look at everything that's sold so far this month, the median sold price is $415,000, which is contributing to affordability. It's contributing to that better cap rate. It's contributing to that median sold price to income ratio. And you can see This is going to be the average sold price, and we are down from the peak 18.73%. $128,000 drop from the peak May 2022. The median sold price is going to be slightly more pronounced. We're hitting a drop of 24.48. 24.48. That is amazing. $135,000. That's what the information that we have so far for the month of September. Slightly less than we were expecting, it being September 8th, but that's just the way the figures play out. That's a 24.48. If you go to Market Cycle on teamprice.com, let's go ahead and take a look at Market Cycle really quick. We do have a adjusted for inflation. And adjusted for inflation, that's going to be the last page. That figure drops down to 31.67%. Adjusted for inflation using today's dollars as opposed to, or, if we were just to simply adjust on what yesterday's dollar would be valued today, that's going to give us a drop of 31.67%. Really incredible to see that. Which is why Austin is becoming more affordable, which is why that median sold price to household income ratio just plummeted, because you've got a drop in price of 24.48% using nominal dollars, 31% using inflation adjusted dollars, and you've got an increase in income over the past 3.5 years. That's going to cause that median sold price to household income ratio just to plummet, which is making Austin more desirable. When you take a look at the median sold price and you compare it to 36 months prior, we are down 11.62%. And if today is the bottom of the market and we use the 25-year compound appreciation of 4.645%, we can expect, and I know y'all like this chart. All right, this is like the number one question. Like, Dan, when is the market going to return to normal? It's like, well, one is define normal. What the heck do you mean by normal? Well, the previous high. Well, that's not normal, but let's talk about that. So this right here. Yeah, right there. Bertina's like, well, what the heck is normal? I agree with you. If we simply apply the 25-year compound appreciation that our market has experienced going all the way back to January of 2000, and we apply it to today's price, today's median sold price, it will take 78 months to return to peak value. That's going to be February of 2032. But I don't know about you. I plan on being here. I still plan on being around, so we're just going to have to keep on updating this information. But isn't that crazy? So the reason why we create this chart is, and I use this chart at a listing presentation because guess what the seller said? Well, I'm just going to wait until the spring so that we can relist our house because I think that things are going to return to normal by the spring. And my response was, well, what do you mean by return to normal? Well, I think prices are going to come back. Okay, well, what do you mean by prices coming back? Well, I remember that, my neighbor's house sold for $895,000 and you're telling me my house is worth $700,000. So maybe we're just going to wait until the spring. And then I just put this graph in front of them and I said, spring of 2031? Like, which spring are you talking about? Well, no, spring of next year. I'm like, okay, so you're expecting the market to appreciate by 30% in the next 4 months. Not going to happen. There's no way that's going to happen. But this is a way for people just to look at it and say, oh, okay. Well, guess what? We just left it on the market, did a price drop to get it sold. So this helps communicate the return to normal mindset. That's what this is for. The average sold price for every single property that has sold so far this year is $570,000. That is going to be a 0.5% year over year increase, whereas the median sold price so far this year is $432,000. That is a drop of 1.9%, which is slightly higher than the drop that we experienced in 2024 of 1.7%, which is really interesting. When you do the percentile analysis, I'm a big fan of this percentile analysis, and that's where we take the bottom 25th percentile of the market and we compare it with the top 25th percentile. Really simple, but let me explain it for 30 seconds. This is what the bottom 25th percentile is. Let's just say that we have 1,000 properties that sell. The first 250 properties, where does that price stop? Meaning from this price and under, we've got those 250 properties. The top 25th percentile is going to be, what is the price of those 250 properties in plus? What is that price? And then we compare that year over year. So you can see that in 2024, 2,837 properties sold within that 30-day period. And then 2025, we've got 2,591. That's going to be an 8.7% drop in activity. That's just raw number of sold properties. And then we take that bottom 25th percentile. 50th percentile is known as what? The median sold price. Well, we already tracked the median sold price. We just got in talking about the median sold price. But now we're going to look at the first 25th percentile. In 2024, the bottom 25th percentile ended at $330,000, meaning 25% of the sold properties sold for under $330,000. In 2025, that number dropped down to $315,000, meaning that the bottom 25th percentile went down in price by 4.5%. And then we did the same thing with the price per foot. And then we look at the top 25th percentile. And the reason why we pull this data is so that we can see, is this what's called a bifurcated market, where if prices are going up, but activity is down and demand is down, why are prices going up? It doesn't make any sense until you break down, well, what is selling? And if you have a price increase in the top 25th percentile, that's going to drive the entire average, the entire median price up, even though the bottom 25th percentile is experiencing a lot of resistance. And then we simply look at the difference. So what is the difference within the percentile? How much is one going over the other one? And then if you have a red dot, that means that the top 25th percentile is underperforming the bottom 25th percentile. That's what that means. That's a clear indication of pricing within those municipalities, within those zip codes, going down over the next 30, 60, 90 days. The reason why this is important is that let's just take a look at Hutto, for example. Let's pick on Hutto a little bit because we've been talking about Hutto. Here you have a situation where the bottom 25th percentile in Hutto is down 11.6%. But the top 25th percentile is down only 0.3%. But it is down. Now, the top 25th percentile is not underperforming the bottom 25th percentile. Nearly impossible to underperform 11.6% drop. But because it's also negative, will clearly show us that we can expect pricing within Hutto to continue to go down over the next 30 days. That's how we use this data. That's why we use this data. Here's another number that just came out. When you look at the top 30 cities and you look at the median sold price for the top 30 cities and you compare the entire median sold price last year to the median sold price so far this year, how many cities went up in price? How many cities went down in price? 10 cities went up in price and 20 cities went down in price. And then you've got the absorption rate. That's simply going to be the sold divided by the active. And we're at 17.41%, which is way better than July. July, we hit 16.3, so that is good news. And this does not go to September. I don't start updating this chart for September until the third week of September. Because if I were to update this right now, it's only going to capture all of the sold so far this month. It's going to give you an absorption rate of like 4%. It's going to look terrible, but that's not real because we're only 8 days into the month. So I wait until the end of the month to update this figure, and then we obviously update it on a daily basis. And if you wanted a score of the Austin market, the 6-county area, 0 to 10, 0 meaning there is no market. Like you might as well stand in the corner begging for money. There is no market. Nothing is selling. And we've only had 1 month with a zero. 1 month, and that was January of 2009, just a few months after the Lehman Brothers collapse. And boy, I was in business back in January 2009, and I'm telling you all, nothing was going on. That was a zero. The historical average is 6.6, and I am happy to inform that we're at 5.44 for the previous month. And that is not bad given the fact that that's the highest figure for all of 2025. So we just closed out the best market flow score, which takes a lot of different figures in. It takes the active to sold ratio. It takes how fast are things going under contract, how much of the market is being absorbed. What about turnover rate? How fast are things turnover? Days on the market. It takes all of that, and then it just plots 0 to 10. 10, the market could not possibly get any hotter. It doesn't matter what the price is. It doesn't matter what the condition is. It's going to sell. Everyone is buying. 0, doesn't matter how good the price is. Doesn't matter how good the property is. No one's buying anything. We are right at 5.44, which is a really nice improvement for where we've been all of 2025, lagging a little bit August 2024. The key is going to be this next month. What in the world is going to happen September 2025? I will say right now that historically, over the past 2 years, September was slightly slower than August because we now have a very short selling cycle within the Austin market. And when you look at the new listen to pending ratio, when you look at some of the other indicators, it does look like September is going to be slightly softer than August. My hope is that we simply beat September of 2024. I am hoping for a higher figure than September of 2024. That was 5.14. That dropped from 6.08 to 5.14. We also had a drop in 2023, and we will know by the end of September on where this number is going to be. You all, it is 11:03 right now, and that concludes our Monday morning touch point. Lots and lots of information that we just went over. Do not forget that we do have our Zoom training, our broker Q&A Zoom training on 10 a.m. Wednesday here over Zoom. Be sure to log in for that. And then we are having our Stats Thursday where you get to post all of our weekly stats. We do not have a team meeting this Friday. I want to remind you that we do not have a team meeting this Friday. We had a meeting this past Friday. We do not have a team meeting this Friday. You're going to receive like 1,000 emails reminding you that we do not have a team meeting this Friday, but we do have our Wednesday broker Q&A, contract proficiency review. If you have not done your weekly contract proficiency, I want to encourage you to do that contract proficiency. I emailed you that, but you can always go to learning on resources.teamprice.com. You can click on contract proficiency and you can take a look at this contract. If you have any questions, comments, concerns, criticisms, or complaints, feel free to reach out to me and I will chat with you later. Thank you all so much for joining. Super appreciate it. Have an amazing rest of your day and I will chat with you later.